Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you've started your portfolio but need some help continuing to grow, 2022 REB Buyer's Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello everyone, Grace Ormsby here. Welcome back to a brand new episode of the Smart Property Investment Show. It's been a pretty crazy year so far, and looking back at some of the episodes that we've had, we've talked to some pretty amazing people, and today is going to be very much the same. I'm very excited to be welcoming Trevor Fuller onto today's show. Trevor, thank you so much for taking the time.
Thanks, Grace. Thanks for having me on the show.
Trevor, you did reach out to us. You sent an email to editor@smartpropertyinvestment.com.au. Thank you so much for doing so. You just sent a little email saying, hey, I think I might have a story that's worth sharing. And I had a bit of a read and went, absolutely, we'd love to have you on the show. Thanks again for doing that. But I'd love for all of our audience to get a bit of an idea of how you got into the property space, if you don't mind. Talk us through what initially got you interested in property investing.
Yeah, I started out as a trainee accountant, and through that experience, I got to see a whole range of different companies and what they'd chosen about how to run their businesses. And some of those were share investments, some of those were property investments, some businesses that sort of bought super fund property. And from that I started thinking about how I was going to sort of make my million, as many accountants do. And and then I started from there. I sort of looked at different options, and probably started out in a little bit in the shares, but also then thought about how I'd love to buy a place of my own. And my brother and I sort of got down, we had a conversation one day about, and that was at that stage I was 19, my brother was 18, and we sat down and thought, look, how can we go about buying our own property? And from there, we also had a friend of ours that was interested, and the three of us sort of sat down and I put together the financial scenarios about what it would take to save a deposit and what we might be able to do from there. And that started the journey. Once I'd realised that it was possible and that it wasn't going to be too onerous an investment for us if we sort of put together money on a weekly basis, that really started my interest.
I'd hate to age you here, Trevor, but was that around the 2000s that journey began for you?
Yeah, we ended up buying in 1999. It was actually it was an interesting time just with the introduction of GST and what that actually meant for the property market as well. Yeah, so it was quite early. It took us the 2 years before we'd sort of saved up the deposit and, bought in 1999.
What was the property market like at that time? Because we do have a lot of people on this show. The reason I ask, we have a lot of people on this show that are only really started investing in the last decade, but you would have seen a lot more over 2 decades than you would have in one.
Yeah, it was. Everyone sort of sits here and we say affordability is a problem, and it felt the same back then. In hindsight, it's different about what the amount of money you save up for a deposit, and that's probably changed. But back then, the market was still increasing. There was still a version of sort of FOMO out there where, we felt like we were chasing our tail to try and be able to afford the place we wanted. So, very, very similar in that regard. And it seemed that, we paid sort of $140,000 back then for a 3-bedroom house, and that seemed expensive for what we were getting. Obviously, little do we know now what, you certainly don't get that for $140,000 anymore.
Definitely not. So that was up in Newcastle, that property.
Yep.
And how long did you actually hold that first property for?
So one of the interesting things that we sat down at the start before the process, I sat down with my brother and we actually had our friend decided not to proceed with the investment. We're quite late on in the piece. And one of the things we'd done beforehand was I said to both my brother and our friend that, look, I think we really need to sit down and look at our scenarios and what happens in the event that someone doesn't want to continue with it, and whether we get partners and our circumstances change, whether we wanted to sort of move on and buy another property ourselves. And so the advantage of that was that once it came down to after about 2 years' time, loved the place. It had, from a brother and my perspective, we had a barbecue area at the back. We had a bar in the lounge room, a double carport. So a great pad for the two of us and at our age, but circumstances changed. My brother ends up with a partner at that stage and she moved in to the place. And then myself, I ended up with a partner as well. And having the four in the property at the same time didn't really sort of work. So I moved out. And then it became an investment. And the one thing that I sort of noticed was that it was great as an owner-occupier property for us, but when it became an investment for me, we tried to come up with a reasonable price of rent to be paid to me for the share that I had. But as an investment, I just didn't think it was a good investment for me, the return I was getting. And that sort of prompted the conversations about selling. And one of the tough bits with that was that the market was actually rising at the time still, and trying to agree a price that if my brother wanted to buy me out, what that would be. And that proved really difficult, to the point that my dad got involved in that process and tried to sort of come up with a price that he deemed it was worth. And we actually couldn't agree on a price in the end. And I'd viewed that it was worth more than what my brother and my dad viewed. Naturally, I'm the one trying to sell and they're trying to buy. And so, it ended up being 3 years that we held the property for. And at that stage that we had no other option but to sell, which we did, and took our profits and went our separate ways. So I went into the share investing, and my brother then bought another place from there.
So a fair bit of, negotiation would have gone on during that time. I do feel like you had some pretty strong foresight to, be working on an agreement and looking at different ways that you could be approaching that, turning it from owner-occupied to investment. But interesting that you already at that age knew that it wasn't necessarily the best investment driver for you moving forward. Have you chalked up many lessons to that experience?
There's definitely, I think one of the experiences, certainly around the price side, was that I've always been someone, which will sort of flow through in further conversations, where I've spent a lot of time reviewing, understanding the market that's playing out. And that was something that when it came to the price, that it actually worked out that in hindsight, that I was probably right on the price, that it was probably worth what I thought it was. And we even achieved probably a little bit more than what I thought it was worth. And then I probably didn't appreciate at the time, but I was really I'd built this idea of what I thought an appropriate return was as an investment property. And that sort of flowed into years later when I started the investment journey again. I sort of went back to that same space and probably got a bit more detail with that decision. But I think that's something that I was effectively focusing on early on. I'd already sort of worked out, I'd already sort of done a sort of bit of a model on what I thought, obviously, to come up with a deposit on what I think the property might be able to achieve from a return perspective. So as soon as that, obviously, circumstances changed, and I sort of revisited at that stage probably a more simple model, and then I sort of worked on more detailed models later on to achieve sort of the same perspective.
And we're going to come back to all of that just after a break. But before we do go to that break, I would love to ask you, Trevor, how much that time spent as an accountant too in those early days was, you're obviously a numbers guy and love working through numbers. Was that really, really valuable to you on that first experience? Yeah,
without a doubt. It was, as I certainly, before that, I'd had an interest in sort of more economics, and then obviously got into the accounting side, and it was extremely valuable in the experience and just what I saw, and really having the opportunity to sort of see companies that really sort of made some good returns on investments that they made, and then really sort of understanding them, being able to go into the detail to understand what it was that they did to achieve those returns. That was, without a doubt, it was extremely valuable to me and what I chose to do going forward.
I'm guessing you're pretty handy with those tax depreciation schedules too.
Yeah, I've I think the advantage with that side of things was I'm a tax accountant as well, so I sort of was aware of what options there were around the sort of tax depreciation, and that sort of played into some future decisions in investment properties where I was aware of the right times to invest the money into a tax depreciation schedule. And yeah, in particular, there was another one later on we can talk about where some people don't realise around there was a renovation done on the property, and I realised that there was a significant renovation done on the property, and I went and got a tax depreciation schedule on to understand what the renovation was. It was an older building, but older property, but because there was a significant renovation, I was able to get quite a significant tax depreciation claim over the years that I held the property.
We're going to take a quick break there. We'll be back soon with more from Trevor Fuller.
Ever wondered how you can invest like the top 1% of Australian property investors? Henderson Advocacy has been at the forefront of helping everyday Aussies improve their financial freedom. So if you're a savvy investor or someone just starting out on their property journey, give Henderson Advocacy a call today. Head to www.henderson.com.au. Don't invest alone. Invest smarter.
Welcome back to this episode of the Smart Property Investment Show. I'm joined by Trevor Fuller, who has just been talking through the first property investment purchase that he did make all the way back in 1999. Talk us through, Trevor, before we get onto the rest of that portfolio, actually. I'm very curious the point you made about the GST coming in at that time. How daunting was that, to be looking at property at around that turn of the century?
Yeah, it was at that stage, it was just, which sort of plays out with something like COVID later on, where there was just a lot of uncertainty about what that meant for the property market. So we're in situations where certain property that, you had this option where GST was effectively a chance of being added to different purchases, and then you had the different grants that were being applied. So we were actually in a crossover period. So because we ended up that we bought after the GST came in, we missed out on the first home buyers grant. So it was sort of a bit of a, I think it was the other way around. I think we bought before. But yeah, we ended up in this situation. There was just uncertainty out there at the time about what we were, and it seemed as though it was going to be increasing the property market. That was sort of the sense that I got. So it just added to this desire that we wanted to get into the market as soon as possible to hopefully benefit from that. And I personally feel that the market did, I think it was before then, because once the GST did come into effect, we did actually get some sort of benefit or rise in the property market at that point in time.
I'm really glad it didn't phase you, Trevor, because you do have a great property investment story to share. I know it was a little while after that you then bought a second property. Can you talk us through sort of the intervening period between that first property purchase and then the second?
Yeah, at that point in time, I worked in an accounting firm with some partners who were pretty heavy into the share investing. So then I sort of moved in that direction. Yeah, it wasn't uncommon for us to sort of talk about share trades during the day. So that got me in the share trading, which is something I then traded on margin for certainly sort of the next 5 or 6 years. And I went over to London not long afterwards and even proceeded to trade, randomly getting up at the crack of dawn to before the market shut, Australian market shut, so I could make some trades. And then likewise at 11 o'clock at night, I might have been up during the week in particular, probably making trades. So I did that for a while, and I think that sort of probably was a driver between pushing me back into property in time, where I realised that being picking shares and trading on margin, one, you couldn't get the same leverage you could with property, and two, it just seemed a lot of hard work once you owned the asset, rather than something like property investment, where at least you sort of do the hard work early on, you hopefully pick the right investment and sort of stay in sort of more longer term. So then after I came back in 2011 from London. At that stage, didn't really have any savings behind me. And so that was sort of the first thing, was really sort of get myself a job and start the savings cycle. And then once I started to build up some savings, I really started to think about, how am I going to use this money the best to grow wealth? And that led me, based on my share trading experience, to sort of head towards property. So then I started to really sort of put together some sort of basic Excel models on, what sort of, with a certain amount of growth and using the leverage of borrowings, where did I think I could get to with an investment property? And then it also headed me back towards that that investment return and sort of rental return that I thought I could get from a property. So I know you sort of talk on the podcast a bit. There's another podcast in the area that sort of talk about whether you invest in the regions or not. And my decision was I'm a value investor. I was with the share trades as well. And so therefore I'm trying to find something that's undervalued at the time. And I strongly believe and still do that when the rental yield often reflects undervalue in a property. And so my belief is that you move back, that the property eventually will move back to its normal rental return. And the way it does that is obviously through the price increase over time. And that was where I started to, based on my value investing experience with the shares and that same concept. Then I started to think about where would I like to buy that investment property. And that's when I started Googling. Has a lot more information out there than when I first bought, looking through the papers for the properties for sale. And then I started to realise that there were some areas outside of where I lived that might be the best option to get the rental return that I was after.
It would have actually been a very interesting experience having bought that first property, the turn of the century, and then, coming back 11, 12 years later, as you said, the internet made it. Did it make it more accessible? Do you think property investing has kind of changed over the time that you've even been in the game?
Yeah, I think even the property, what information's out there like today is very different again to what was in 2015. So by the time I bought the first investment property, when you there was definitely information where you could find out about on rental yields in different places around Australia, but I wouldn't have said there was huge amounts of information out there on that. And you really had to sort of search around for it. Whereas now you've got, a lot more people putting information out there for you to utilise. And I used, at that point in time, the most common thing I used was sort of the property investment magazines. So I would go on a holiday somewhere. If I ever went on a flight, I would go to the airport. I'd buy my magazine. I'd go to the back section. I'd brief through the stories and more sort of head to the back section and literally go through line by line with suburbs and what was the rental yield, what was the vacancy rate. And it brings me back. I used to do a similar thing years ago when that was the way you sort of worked out what share prices were. You went to the business section of the newspaper and scrolled through to find out what the 3-month return was or 52-week high was. So that was actually a really valuable tool, was the magazines at that point in time, probably more valuable than the internet. Whereas I think now it's completely changed, probably the other way around.
Definitely a different time. Trevor, talk us through then what that first property purchase was when you did come back to Australia and get your foot back on the ladder.
Yeah, so I'd come across at that stage Lavington in New South Wales. I'd came across that it had a big factor was the rental return that I was able to find. And I think at that stage, I probably hadn't scoured everything as much as I probably did after that first purchase to sort of find the best places. But it stuck out as a place where the rental return seemed pretty good. I thought it was still a reasonable size market to be investing in. And then I sort of looked at one of the other factors that actually played into my decision about buying there versus Albury on the other side of the border was actually stamp duty price and the difference between the stamp duty between New South Wales and Victoria. So that was actually the reason I bought in New South Wales rather than Victoria. And then so once I decided that was the place that I was interested in buying, I researched a few properties and sent emails out to a few agents. And one of the agents was actually really good. And they sort of said, look, I can sort of show you around to these other properties. Although I don't know that necessarily that happens too much these days, but that agent was quite prepared to show me a whole group of properties. So I've been to a wedding on the Saturday. I drove an hour on the Sunday to Albury or Lavington and met with the agent, and he took me to 4 different properties, drove me around. I said, I don't know if that's probably doesn't happen these days, but very good to do that for me. And then I found one. It was wasn't the one initially on the radar, but I really liked what I saw. I felt that there was, in that regard, I sat down once I'd sort of been through all the properties and sort of went through what I thought I could get from a rental return from each of the properties. And that was something that I felt was really important. It wasn't just relying on the agent to sort of say, oh, look, I think you can get X amount of dollars for it. I'd actually went through and looked through all the properties for rent that I could that sort of matched that same property. And I was really confident in when I went to the agent to sort of or make an offer that I sort of knew in the background what I could achieve from a rental return perspective. Yes, I met on the Sunday. By Tuesday, I'd made an offer on the property, and I think by Thursday we'd agreed a price, and then the journey started. Which at that point in time, I was quite uneducated about, even as much as I'd bought many years ago, about what I actually needed to do it as soon as that we'd agreed on a price. So yeah, then I went through the process with conveyances and how do I find one. My dad was, as someone who'd bought a few investment properties by that stage, and I reached out to him and sort of said, what do I do now? Yeah, building pest inspections and those things that I sort of hadn't really, I'd sort of got to the point of working out what do I need to make an offer and buy a place. But once it obviously happened, I hadn't sort of gone through the research on what I need to do next.
So a bit of a learning curve for you then.
It was, learning curve in that one. And then that sort of, and it was great to go through that because it gave me so much confidence that later in other purchases that I just knew what I needed to do, and that I could, certainly gave you confidence with putting an offer in, even though there's different rules in different states as well. So that was one of the other things that I also had to learn was what are the rules around making offers and having them accepted in New South Wales. They're different in other states. So that was something I'd read about that I needed to make sure I understand, and cooling off periods and things like that.
Absolutely. So can you talk us through some of the specs on that first property? Yeah,
so it was really, the key was understanding really the contract was important. So I need to understand what cooling off period I had, what time period I had to make sure that if I didn't want to proceed with the purchase, that I had the option of pulling out of the contract. So whether that was, if it was unsuitable from a building and pest inspection, and really understanding what that meant as well. So if it was an unsatisfactory building and pest inspection, like what did that mean? And then finance, how long I had to make sure that my finance was approved. And likewise about what that meant if it wasn't approved. So then that's where obviously with the conveyancer, and that's where even at that point in time, there was some good information out there online around what good conveyancers there are in the area. And that was another thing to understand, like did I need a conveyancer in the area as well? Sort of the other thing I was starting to research as well is obviously this was going to be an investment to me. So I needed to know from a property management perspective, what was the going rate for property management fees in the area, and how would I pick an agent? Would I go with the agent that I had already, that I bought from or not? So certainly it was, I really had to make sure quite early on that I knew those rules and knew that, on the last point that I had an option before things went unconditional.
Mm. And was it a 2-bedder, 3-bedder?
3-bedroom place, and had quite a large yard. It was sort of, I think, around 900 square metres. So it was something that I knew down the line. It gave me some flexibility that which I played around with over time about whether I subdivided and did something different on the property.
Mm. And you talk about being a value investor. Does that lend you more towards buying for the capital gains or for that cash flow coming through?
It was really driven by cash flow, but I felt that I've never thought about, from my perspective, I've never looked at having a negatively geared property. It's always been the aim to have positively geared. And I felt that for me, that the capital growth was a bonus to me. But I felt that it was interesting, it did play out in other decisions, whether there's another one later on where I possibly thought about maybe a variation on that. But initially it was always around positively geared. Because the one thing I always felt was I knew I had that. I knew what the rental market was and I could get for that property. The capital growth, you can't guarantee. So I sort of felt that was my way that I chose to invest at that point in time.
So moving on to the next property, but actually before we do you still have that property, that Lavington one?
No, I don't. I don't have that property.
No. Okay. So we'll get to the next one then. What did you then do? What was your next property move after that?
So then I felt that, I guess in hindsight, I look at it and say that it was a good investment, but there was definitely better investments out there. So when I mean better investments, it's more around that I felt once I started to look around further, I started to see that there were other options, that other properties in other areas that offered better rental return than what I was getting in Lavington. And that's where I came across Mowbray in Launceston. It's about 3 kilometres outside the CBD. And on paper, and like I did with every property I purchased, I've always made sure I visited that area first to get a first-hand perception of what it's like. So on paper, Mowbray seemed good. Better rental return. There was a lot of, from my perspective, they had, it was very much an investment area. You had the Maritime College, the university camp, one of the university campuses was there. So I felt on paper it seemed good. And then I think one of the things I've done over time is Googling about that area. So like, what is Mowbray like? And just trying to get a sense of whether there's any blogs or anyone's written anything about whether it's a good area or not. And I was lucky my cousin lives in Launceston. And so I mentioned to her that I was looking at Mowbray as an option to buy. And she offered to take me around Launceston and show me Mowbray and the surrounds. And her partner is from Launceston. So it was also interesting to get an opinion on Mowbray from someone who'd lived there all their life.
Very cool.
And the opinion was that it wasn't necessarily the best area, although when I was there, it didn't seem like it from my perspective. I felt there was still good infrastructure. It was still close to the CBD, and I certainly didn't get that view from driving around the area.
And looking back now, I mean, Tasmania is a pretty good investment for anyone who's been in there for a little while now.
Yeah. And it was interesting. You look at things now and you sort of say, well, I've since sold the Mowbray property as well. But one of the things that sort of led me, once I did buy that property, I certainly realised I still had strong views on that it was a really good market to buy in. So, yeah, and then it led me to buying again pretty short time afterwards.
So talk us through that one then.
Yeah, so that stage, one of the things I always wanted to keep on top of was what my borrowing capacity was and how I could refinance to buy other properties. So that's one of the things I've refinanced multiple times with different loans. I've taken parts of, so I got one of the things with the Lavington property actually quite early on was I was able to get a very good valuation. From the bank. So they didn't do a full valuation, but on the bank valuation itself. So one of the lessons that I'd learned over time was to just keep going back to your broker every now and then. You can get a free bank valuation off them every 12 months, I believe. Well, that's what my brokers advised me. So I went back to them and sort of said, what's the bank valuation you're getting at the time? And it came in a lot higher than what I thought the value was, which enabled me to then refinance against that bank valuation and use the funds to finance the next property purchase. So that's what I did with the second Mowbray one. And looked around and same thing, stuck to the 3-bedroom house model. That was just something I've always had all along in the back of my mind as the sort of the right market. That's a property that appeals to a lot of people. So I quickly found another property, flew back to Mowbray, had a look. And then interestingly enough, this time I had a couple of differences. So the first time with the negotiation, I felt that it went, well, both negotiations before that were pretty straightforward. Obviously, I put an offer in, counter offer, then I make sort of another offer. And one of the things I'd also learnt from the first Mowbray purchase was an agent that I got to know quite well in Tasmania, in Mowbray, a guy, Richard Bailey, had mentioned to me, don't offer an exact value because people think that you can afford to pay a lot more. So he said, always offer a really unusual number or like a 500 or a 700 or something like that to the end. So that's something that I used then with Mowbray and the second one in particular. So I put an offer in and the agent rang me and said, look, before they want to accept your offer, they want to show someone else through that's interested. They said you can basically raise your offer and they won't show the other person through, or you can let them show the person through. And I sort of sat down and worked through the scenarios. And from my perspective, I didn't need to buy the properties. They were always, I'm an investor. If the numbers stacked up for me, then I bought the property. But if it didn't, then I walked away. And so when I sort of reverted back to that mindset, I then said, go for your life, show them through. If they come through and it doesn't work out, then I know I'm the only person buying this property, and then I can make the right decisions to make sure I get it at the right value for me. So that's how it played out. The person went through and didn't want the property, so that meant that I could go in and make the offer, and then organised the building and pest inspection. Thought everything was pretty standard. It's the way to go on any other properties, but this time it came up with they found asbestos. And then I spoke to my conveyancer about what are my options in relation to this, and they said, well, effectively it's an unsatisfactory building inspection, and so therefore you can withdraw your offer. And one of the options was withdraw your offer and then put in a new offer at a lower price. So that's what I did. Although I wouldn't say I got a huge discount as a result of it, but I did get a lower price than what I first. Eventually, we played around. I think the selling agent on the other side was a bit annoyed with me for doing that. They thought they had a sale all well and done, and so they obviously lost out in this whole process. But obviously, I got a bit of a discount on that price, and then I could obviously choose whether I remove the asbestos or how I choose to deal with that as I went along. So, yeah, and that was probably even. I felt it was probably a little bit better investment than the first one, and I thought that I could get a similar price and probably a similar sort of rental return. So, and both those Mowbray ones I was very happy with in time.
Well done on calling that bluff, Trevor. It's obviously not always going to work out for investors when they do things like that, but I think the key thing is to remember that you are an investor, and there's always going to be another property that may suit you better if the current one that you're looking at doesn't. So some good words of advice there for any investors listening. We're going to take a quick break there, and we'll jump back on with Trevor Fuller to find out more about his property investment journey.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Welcome back to this episode of the Smart Property Investment Show. I'm joined by Trevor Fuller. And just before the break, Trevor gave us some absolutely great advice on negotiating a property purchase, which I think is quite important insight for people to be thinking about at this point in time, especially we're seeing a pretty big switch away from a seller's market to a buyer's market. And that's pretty good news for investors who probably do have a little bit more wriggle room than they've seen for the last couple of years. We've just talked, Trevor, about your properties that you purchased in Tasmania. Do you own either of them now?
No, I don't. I have spent some time looking at the current valuations or estimated valuations, and it would have been nice to continue to own them.
Yeah, it's really interesting because a lot of the people that we do speak to, are very much about buying and holding their properties. But so far in this story, you have not held on to any of the properties that you bought early on in your investment journey, but you're still doing some great things. So it does make me curious as to what was next for you after that.
Yeah, so at that stage, Mowbray, I had in my mind, I didn't think I could achieve the same rental return that I could when I sort of next looked around for a property. So once again, went back to the drawing board, looked for areas with good rental return, and they generally of all things, most of them tend to be sort of fairly lower socioeconomic areas. It tends to be where, from my view on most of this over time, is it's something where that the property prices in some of these areas have dropped low enough that the rental return, when they're sort of the further they go out of the CBD, but the rental prices don't drop accordingly, and that obviously creates the rental yield in those areas. And then I came across Elizabeth in Adelaide, and so proceeded to head over there and look at the area, which some areas of Elizabeth don't probably have the best reputation, but I did come across a gated community. When I say gated community, it's a community title that just happens to have a gate around the outside of it. And one of the things I probably wasn't aware what community title was at that point in time. Just noticed that the area I felt. So I looked at things from still I was happy with the rental return. I wasn't getting the same yield that I was getting in Mowbray, but I did also think that I felt there was some good infrastructure around the area, and that long term, I felt that there was an opportunity that I didn't think be hard for prices to go lower, but I did think there was an opportunity that it just might be something that there might be some capital growth because Elizabeth catches up with some of the other areas around it that are more higher priced. And then went through the process, put the offer in. It was actually a bank repossession. So I spent all my time trying to work out this negotiation process and what am I going to offer on this property. And then to my surprise, I put in the offer and they accepted it. So I'd sort of wasted the time there. I would have gone lower if I'd known they just wanted to get rid of it. But from there, I've got the contract for sale and realised that I had this scenario I needed to pay community title levies. That's when I sort of spent the time. So a bit of advice, make sure you read the contract. I've had some conversations with other owners that have bought into the community since that necessarily probably haven't read the contract and realised they need to pay these levies. Purchased, was happy with that in the end. I was still happy with the return that I was getting, the net return after those levies. So I proceeded to buy the property there. And then about 12 months later, I went to the annual general meeting for the strata community and had all my questions organised as a good accountant would on all the finances to understand where we were spending our money. And next thing I know, people wanted me to be the treasurer on the committee. So I ended up as a treasurer. And then I spent the next sort of 6 to 8 months probably emailing the strata manager with further questions about why we were paying different things and why our disbursements were really high and why our printing and stationery cost was, why we were sending AGM notices out in colour and posting them and so on. And as a committee, we then decided that we thought we might be able to manage the community ourselves, and which my experience was probably was going to be used the most to run that community. And from there, we decided to go through the motions and put it out to owners whether they wanted to terminate the contract with the strata manager and have the committee run the community. And as of today, it all went through. It was quite unusual, actually. We went to the meeting. We had 2 agendas. Went through some standard things at the start of the meeting, and then there was an agenda B that was if the strata manager stayed on, that we went through agenda B. And if they terminated with the strata manager, they were voted out, then they left the meeting, and I ran it from there with agenda C. So I still manage that community today. So we've and I feel we've been able to do a lot of things. We've developed that community a bit, and I think as a result, from what I've seen from some of the sales in the community, people have done well out of their investments there.
Gosh, an interesting turn of events. I bet you didn't think that was going to be the outcome of purchasing that property then?
No, certainly not. And then the same thing is almost like a property purchase. Once you go through and think about, okay, let's I think like we can manage this community as a committee, but then having to work out practically how that happens, and it had to happen really quickly. So setting up a virtual phone line that we have today, to setting up a method to pay people but people can pay the levies, so a payment gateway, and then things like setting up the zero accounts and making sure I can send information out to everyone. So there's lots of changes that have been made over time to sort of streamline that, but it was certainly something that moves really quickly and was further lessons to me on probably understanding also community title and what that means, because there's some separate things people don't. There's certain things that the council allowed to happen as a community title that's a bit different. So we own the roads, the street lights. So we take for granted that everywhere else you have a street light out and the council comes and replaces that. We have to do that ourselves and get a cherry picker in and pay for it. So it's a bit different.
There you go. Some interesting careers come out of working within the property investment space. But very cool, Trevor. I know, though, that that's not the end of your property investing journey, and we're getting to the end of this episode, so I want to get through everything else if possible. Talk us through what's been going on since then.
So then being happy with the investment with Elizabeth, I sort of purchased another property in Craigmore, which is a nearby suburb that I felt was slightly better area, and I still felt that there was good value in the price there. And so I think it was about 12 months later. Quite randomly, I started struggling to find properties to buy. Instead of going onto realestate.com and searching for the most recent properties, I turned it around and searched for the oldest properties in the hope that I might take away the competition. And then that led me to the place in Craigmore and quickly raced over on a flight, had a look at it, and was really happy with the property. And it had been advertised for sale 12 months before and didn't sell, so I thought I had some bargaining power there. And then obviously the sales of the properties, the introduction into the strata world, pricks my ears, I suppose, to that industry. And that's when I eventually sold a couple of properties to raise funds for a deposit to buy a strata management business or a franchise that I'm running today in Victoria, a group called MBCM. So I work for them now. So I still obviously do the community in Adelaide while managing the properties in Melbourne. And then not long after that, so I'd sold the 2 Mowbray and the Lavington properties at that stage. And then COVID hit and lots of doomsday scenarios in the papers. 40% drops in house prices. And I just had in my mind that I just didn't think it was going to be that bad. So I thought that while there's a bit of negative sentiment in the market at the time, that there might be an opportunity to buy. So my wife and I looked at we started looking around, and one of the things I was interested in was we were looking at a unit. Didn't really have the deposit for a house that we would like just yet in Melbourne. So we looked at a unit, and we're looking at something that was a little bit unique rather than sort of your standard sort of 2-bedroom, 2-bathroom unit. So we came across a 3-bedroom unit, 3-bedroom with like 2 car spots as well. Yeah, it had been to auction, got passed in. So we went and visited the property and had all the COVID restrictions in place at that point in time about, inspecting properties. And, I was happy with what we saw and put an offer in. And funny enough, we got the same thing, went through the rigmarole about what price to put in and just got accepted. It was the developer selling off the property, so they were just happy to offload it and move on. And then, then that led me to, with the business, there was came across a new development that was happening in the Richmond area where I manage properties, and thought it might be a really good opportunity to similar size office to what we're in and buy that investment through a self-managed super fund. We same thing, COVID, thought with commercial offices that there might be a bit of uncertainty around the office spaces when everyone's starting to work from home. So I thought it was a good opportunity to try our luck and see if we can get a bit of a discount on the current prices, and managed to do that. Same thing, first commercial property experience, and that brought some new things and first off the plan. So that's going to bring some, I'll go through that process in time, but I'm confident with what I've been through on the strata side of things myself, to then obviously understand what's involved in that process. And so I've been involved with a property that's a new build, effectively a new development's been taken over and new owners moved in. So I understand from their side and on my side what's involved. So I'm confident that when that settles later on next year, that I can work through whatever's needed to make sure that I get exactly what I need out of that investment.
That's got to be a little bit handy at this point in time to have an extended settlement period.
Yeah, I think it's hard. And one of the things I also had to do in that process was understanding things like sunset clauses and what that meant, and to understand whether, how I could end up paying a deposit and then being, and I'd heard other stories where those sunset clauses had expired and people have, effectively then had been refunded their deposit, but obviously lost out on their investments. So I certainly I went through my due diligence to understand what that process was involved. But I had to understand what it's like to bid on an off-the-plan investment and what's involved. So I've also had some good conveyances over time that I work with one, with both the purchase that we made ourselves as an owner-occupier and all the commercial one, and obviously get some good advice from them about what we need to do.
And so, Trevor, where are you at now? Can you just give us a bit of an idea on what your portfolio is actually standing at value-wise, and then what your sort of next steps are going to be from here?
So I've got so obviously the place we live in, the unit, the 3-bedroom unit, which One of the other units in our complex sold quite at a really good price. So I think we're probably in the vicinity of around $800,000 that we've got in that investment. Still got the one in Elizabeth, the community. So I think that's probably around the sort of a bit over $300,000 now, which is quite a good profit on what we've initially sort of bought in at. And then we've got the commercial office, which will sort of around the sort of $450,000 investment there. And then from here, the next stage, as it gets closer to retirement, I think it'll be more like in years to come, it'll be more from my perspective. I'd like to transition into more commercial investments, particularly in the self-managed super fund. So from a business perspective, it'll be really at a time in the future, sort of increasing the super contributions to the self-managed super fund and then utilising that to buy sort of another commercial investment. I remember actually with Phil on the podcast going through his experience with sort of the commercial investment and those sort of things, and that sort of stuff's really interesting for me to go through the sort of numbers involved in that sort of investment. I think I like the fact that you've got the indexation and obviously generally sort of better returns. And I'll probably at that stage I'd have the time to sort of make sure it's got the right business in it. One thing in time with the investments is certainly from the commercial one we're in is having a strata manager as a tenant is usually pretty good. It's a good recession-proof industry to a certain extent. So yeah, and then looking to increase the size. Like at some stage it'd be around in building on what we've got now, whether we buy a house, sort of probably the time frames around the sort of 5 to 6 year viewpoint, just around what happens from the business perspective, the strata business side of things, whether I could buy another franchise or something in time and might need funds for that. But from a property perspective, it's increased the commercial investments in the super fund and then upgrade on the personal front.
It sounds like you love working. I don't want to put any words in your mouth, but you're talking about your business and how you've gone into business since being in property investment and, then potential plans to buy another franchise down the track. It doesn't sound like you're doing all this, Trevor, to then retire and not have to worry about doing anything. Is that a fair enough statement to make?
I think it's certainly, I do love, without a doubt, the getting involved in the community in Adelaide is something that just really sparked interest, I think, as a combination of the finance side and managing that process, trying to do the right, in my personal life, I try and save money where I can, forecast out finances and those sort of things. And so I think the finance aspect is something I enjoy. So it's great to be doing something I enjoy from a work perspective, and also building the relationships with owners. So in that community, everyone knows, they know of me. A lot of them will call me personally, even though we've got sort of community line. And then the same thing on the strata side, it's the business as well. It's building these relationships with owners. The previous franchisee before me was in it for 13 years and the owners became friends of his in time. So I think I love getting out and meeting people. So the combination of those two and trying to be efficient and organised, which is what it is. So it's definitely going to be hard for me to then just stop doing that side of things. When you enjoy what you do, then whether it's, and it might be something that it's more managing tenants in a commercial business or commercial property they own or something. There'll be something in the property space that I'll continue with regardless. I just can't see myself ever moving out of there.
Yeah, I love that. So it's not like we're expecting a retirement notice from you anytime soon because, property has clearly become so ingrained in your life and just it's a lifestyle for you.
Yeah, it is. And I'm also mindful, though, I think I've got obviously forecast things out. There's a point in time where you obviously want to choose the right time to retire. And it's really when you've built up that wealth in the property side of things that it can deliver a lifestyle for you. So the Elizabeth Park property was always, the intention was to keep that long term, and that it provided to be able to have that good rental income coming in retirement, and the same add a couple of commercial properties to that. And all of a sudden, they should be able to create a healthy financial lifestyle in retirement. So it's just going to be a battle between when we get to that stage. But obviously, I can't see how I would. I think it's going to be a very gradual step away, right? And that's something that the industry offers. At the moment. So, like I have someone working in the office that that has 3 kids, and she works 1 day a week for myself and 1 day a week for another franchisee. So, and that's just the strata industry, something that does offer that flexibility. So whether it be something that I drop off and maybe play a bit more golf as time goes on and less time in the office, but there's also flexibility. I can work from home and or in the office, whatever sort of suits. So that's great about the industry, right? That I've got that down the track.
Absolutely. I'm already excited, Trevor, for the update episodes that we're going to be able to do around some of your commercial pursuits in the future. So please keep us up to date. Let us know when you make some of those purchases and what's going on, because it's been an interesting story so far, and there's so many other questions that I could be asking you right now.
Thanks, Grace. Appreciate the opportunity to sort of talk through some of these and going through this experience also. Even just to remember all the things I've been through myself is, there's certainly the lessons that I revisit as well, that I need to make sure that any future property investments that I sort of follow those.
You can see how far you've come, and now it can be a point where you then look for the next episode and what we'll be talking about there. But Trevor, again, thank you so much for your time today. I hope everyone listening has enjoyed the episode. There's a few amazing nuggets of wisdom in there. So if you haven't already jotted some of those down, do a little bit of a rewind and make sure you do pay attention to those. As I said, we hope you enjoyed this episode. Please like or review us on whatever platform that you do listen to podcasts on. And if you have any questions, or you think that you might have a story like Trevor's that's worth telling on the show, reach out, editor@smartpropertyinvestment.com.au. We'd love to hear from you. As always, subscribe to the Smart Property Investment newsletter if you haven't already. Check us out also on Facebook, Twitter, and LinkedIn. That is all we have time for today. Until next episode, stay safe and well wherever you are. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment guide today at purepropertyinvestment.com.